Well, good morning, Bob.
Good morning, Bill.
We're talking about this week as we head into summer, we're talking about the CFPB's two new forms. One is a loan estimate,
Correct.
which replaces the good faith estimate.
That's correct.
It's got to be given to the applicant 3 days within the application time they apply. And the new closing disclosure form has got to be given 3 days before.
At least 3 days.
At least 3 days before.
Right.
Exactly. That's like that. Exactly. And so it's in the effective date is August the 1st of 2015. We're a little more than a year away.
Not much more than a year. You know, realize July is almost over. It's just.
and do you think anybody started thinking about this and planning for this?
Well, we have a little evidence that they have.
They started.
There are a few people that are calling us up and saying, "How can you help us with that?"
Well, and so there's another document that we're going to address next week, and it's called the OCC third-party guidance on a third-party vendor oversight.
Right, and that's sort of over. That's not just related to the loan.
This is everything.
This is everything. Any third-party vendor you use, and it's pretty broad, and they have some pretty significant things to address in that.
And they do, and we'll be talking about both of these, but today our focus is around the closing disclosure, and is it really going to be simpler, or is it one of those statements, we're from the government and we're here to help you?
Well, you know, if you read the sort of the preamble of the regulation, it says that, okay, we have two different regulatory agencies that are requiring different forms, and there's a lot of overlap.
Today it's HUD with
right,
the HUD 1 form.
Right.
And go ahead.
And then under the truth in lending, you've got the good faith estimate.
Right.
And so you've got those two forms, and there's a lot of common information, and yet some of the definitions for the fields, for the same fields, are slightly different. It's a little confusing, and so what I wanted to do was to sort of aggregate that under the Consumer Financial Protection Bureau, clean that up, make consistent forms, new forms, and provide really clear definitions of exactly what's expected in each one, and the timing associated with that.
Well, let's talk about the practical side of implementing that.
Well, I think it's a challenge for the lenders, because you know, the CFPB makes it really clear that if you have a mortgage broker that's taking that application, or if you've got closing agents out there doing it on your behalf, it doesn't cut you any slack at all.
Exactly.
You're still obligated as the lender to meet all of those requirements.
And let's talk about today. Today, if a lender takes an application, they make you a good faith estimate. And as long as there's not a material change between up front and downstream, and a material change, most people interpret about a 10% variance, then we can just redisclose and we're good.
Yeah.
Not so with the new lending estimate.
No, under what they say now is that if there's a material change, and they define that material change as 1/8% or more. Okay,
That's tight.
That's tight.
Tight.
Okay. If they change the type of loan product that they're providing, or if they change any of the prepayment penalty issues, that's a major issue.
We get to redisclose.
You redisclose another 3 days. All right. Now there are some of the other things. They allow you to just create a revised closing disclosure statement and deliver that prior to the actual closing. But if any of those three change, and you know that those change all the time.
Here's what happens, folks. Practically, the loan package goes out to the closing agent. And there are things that move around as we get near closing. Things just move around.
Interest rates, for example.
Exactly. Interest rates move around. I mean, they may be locked, they may be unlocked. There are a number of variables that change.
Yeah.
And so when it's time to close that loan, one of the questions is, did you make the appropriate disclosure or not?
Exactly.
And so there are going to have to be some tests that are run at the lender to make sure there was no variance, no major variance.
And you're going to have to be able to report on that.
That's right.
And document all of that.
And if there was, we're talking about redisclosing and waiting another 3 days, which affects pipeline, it affects hedging, it affects a lot of things.
Yeah, I thought on the front side, at the time that they're taking the application, you know, they have 3 days after that to give you the loan estimate. And it's kind of interesting what they require in terms of their definition of when a loan application is taken.
Right. I mean, we want to do all these pre-apps and pre-quals
Right,
and
yeah.
get it this, that, and the other. And so CFPB had to come out and say, this represents an application.
Right.
So let's talk about the minimum requirements for an application.
You have to have the borrower's name.
Borrower's name.
You have to have their income, an income statement. Well, it doesn't have to
Something,
be
something that
official,
represents their income.
Right. Their social security number, the address of the property, an estimate of the value of the property, which I thought was really interesting. I don't know if that's an owner's estimate. I'm not real sure what the definition of that is.
Well, a lot of lenders up front will pull an AVM, which is an estimate of value.
Right.
Or they will pull a competitive market analysis or do some listings or do something up front. The question is that a necessary and sufficient list or not? I mean,
Right. Well, there is also the loan amount. You have to state up front how much loan you're going for. But all of that collectively constitutes the loan app.
and I guess we're going to see in the courts over time
Definitions.
exactly how far we can bring that back. In other words, what's the real minimum?
Right.
Clearly, if you have those things, it's an application.
Yeah.
The question is, what can we take out of that and still have an application?
Yeah, right. And and then you've got 3 days.
But you're right, because
And
then if you don't disclose,
right.
if you fail to disclose, there's some penalties.
Exactly. So I think, it's going to be a challenge, and we're already getting questions about what constitutes an estimate of value.
We are, and in addition to that, if you have an estimate of value, you must give that estimate of value to the applicant.
Right, and the document that generated that estimate of value, whether it's an appraisal or an AVM value or a BPO or whatever you use.
Competitive market analysis, anything.
Right. Give that to the applicant.
That may not qualify under the OCC's appraisal regulations or the other banking and thrift regulatory agency appraisal regulations as a legitimate estimate of value, but it's an estimate of value for consumer lending purposes.
Exactly, and so I think you're absolutely right. I don't know if it's going to be the courts or the regulators that are going to come out and define that a little bit finer, but they've got until next August.
Exactly. Well, clearly, if we have these things in the bucket, it's clearly an application, right? And so now we get downstream. I think we're going to see lots of consternation over whether we redisclose or don't redisclose the closing disclosure.
Right, and I think the other issue that, like you mentioned earlier, that's going to be a real important one is for them to be able to document and show in reporting that they have done and followed all of these issues, And one of the big problems that the lenders are going to have, they're dealing with all these different closing agents out there, and they're going to have to make sure that they've done the due diligence on that. We'll talk a little bit more about that next week. And make sure that a closing agent follows these guidelines, that they can document those, that the changes are made appropriately, and then actually disclose to the lender.
Well, one of the things that we saw really after 9/11, when the banking and thrift regulatory agencies came out with this concept of Bank Secrecy Act and anti-money laundering, we had this concept of know your customer. Now, know your customer's been around longer than that. It appears as though the OCC has extended that to know your vendor.
Right.
And so we're going to be talking about in the next week or so the concept of knowing your vendor, knowing what kind of risk you're taking when you're onboarding that vendor and managing that vendor, and that's going to all roll into who's making the lending, the loan estimate and the closing disclosure.
Right, and when you look at the regulation related to that, it's not a trivial amount of stuff that has to be done. They have it well broken out segment by segment by segment of exactly what you're expected to do to qualify your vendor, and a lot of those things can't be done on the fly.
That's right.
They have to have a lot of pre-planning to make that actually happen.
And that's actually the goal.
Right.
Well, we're out of time, and we're in the middle of summer. This is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic day. Bye-bye, Bob.